Let me ask you something. If someone handed you $1,000 right now, not a loan, not a debt, just free money, what would you do with it? Most people will buy something. Maybe clothes, maybe a gadget, maybe a nice dinner. And honestly, that $1,000 would be gone in a week. But what if I told you that $1,000, invested the right way, could quietly grow into $10,000, $50,000, or even $100,000 over time, without you doing anything extra? That's not a fantasy. That's investing. And it's been hiding in plain sight this whole time. Here's the wild part. The people making real money from the stock market are not necessarily the smartest people in the room. They're not Wall Street geniuses or math professors. Most of them are regular people who simply started early, stayed consistent, and understood a few key ideas that nobody taught us in school. This video is going to change how you see money. Not because I'm going to throw complicated charts at you, but because by the time you finish watching, you'll finally understand what investing actually is, how it works, and exactly how to start, even if you have zero experience and very little money. So if you've ever felt like investing was for rich people, or you were too late, or it was just too confusing to figure out, stay right here. Because everything you're about to hear is going to make you wish you started sooner. And the second best time to start is today. The money system nobody taught you. Here's something nobody tells you in school. There are two ways to make money in this world. The first way is trading your time for money. You show up, you work, you get paid. Stop working, stop getting paid. That's what most of us do. It's not bad, but it has a ceiling. There are only 24 hours in a day, and no matter how hard you work, you can only trade so many of those hours. At some point, you hit a wall. The second way is making your money work for you. This is where investing comes in. Instead of you working for every dollar, your dollars start working for you. Even while you sleep, go on vacation, or spend time with family. This isn't a hustle or a side gig. It's a system. And once you understand how the system works, everything changes. You start to see money differently, not just as something to spend, but as something to deploy. Think about it this way. Imagine you have a worker. Every morning, that worker goes out, does some tasks, and comes back with a little profit. Now imagine you have 100 of those workers, all working at the same time. That's what a healthy investment portfolio looks like. Every dollar you invest is like sending a little worker out into the world to bring back more. The more you invest, the more workers you have. And over time, they start doing the heavy lifting for you. The sad truth is that most people never build this second income stream. Not because they can't, but because nobody ever explained it to them. They spend their entire lives only making money one way, when they could have been quietly building wealth in the background the whole time. You're here, which means you're already ahead of most people. Now let's go deeper. What investing actually is and isn't. A lot of people hear the word investing, and they immediately think gambling. They picture someone nervously watching numbers on a screen, sweating, hoping they don't lose everything. And yes, that exists, but that's not what smart investing looks like. Let's clear this up right now. Investing is simply putting your money into something that has the potential to grow in value over time. That's it. No drama required. When you buy a stock, for example, you're buying a tiny piece of a real company. Let's say you buy 1 share of Apple. That means you literally own a small piece of Apple Incorporated. If Apple does well, sells more iPhones, grows its business, makes more profit, your share becomes more valuable. You didn't have to do any of the work. You just own a piece of the company. That's the magic. You become a partial owner of businesses you believe in. Now here's what investing is not. It is not a get-rich-quick scheme. It is not something where you put in $500 on Monday and pull out $5,000 on Friday. People who try to do that are not investing. They're speculating. And most of them lose money. Real investing is patient. It's boring in the best way possible. You put money in consistently, let time and compounding do their work, and years later you look at your account and think, wow, I barely even noticed that growing. There's also a big difference between saving and investing, and most people mix them up. Saving is keeping your money somewhere safe, like a bank account, where it doesn't really grow much. Investing is putting your money somewhere it can grow significantly over time, with some level of risk. Both matter. But if you only ever save and never invest, inflation, the rising cost of everything, slowly eats away at your money's power. Your $1,000 today won't buy the same things 10 years from now. Investing is how you fight back. Understanding risk, the thing that scares everyone away. Let's talk about risk, because this is the number one reason people never start investing. They're scared of losing money. And look, that fear is valid. It's real. Losing money feels terrible. But here's what most people don't understand. Not investing is also a risk. It's just a slower, quieter one. When you leave your money sitting in a savings account earning 1% interest while inflation runs at 5%, you're losing purchasing power every single year. That's a risk too. You just don't feel it immediately. Risk in investing is not random. There's a concept called the risk-return trade-off, and it basically means this. The higher the potential reward, the higher the potential risk. A savings account is very low risk, but also very low reward. A startup company stock might have high reward potential, but it could also go to zero. Understanding where different investments fall on this spectrum is how you make smart decisions for your situation, your age, and your goals. Here's the key insight most beginners miss. Time reduces risk. The longer your money is invested, the more you can ride out the ups and downs of the market. History shows that the stock market has always recovered from crashes, every single time. The 2008 financial crisis, the 2020 COVID crash. Each time, the market went down, and each time, it came back, and then went even higher. So if you're young and investing for the long term, short-term drops shouldn't terrify you. They should be opportunities. There's also a simple tool for managing risk called diversification. Basically, don't put all your eggs in one basket. Instead of buying stock in just one company, spread your money across many companies, industries, and even countries. That way, if one company fails, it doesn't wipe you out. A single candle going out doesn't mean the whole room goes dark. Diversification is one of the most powerful and underused tools a beginner investor has, and we'll talk more about exactly how to use it. The types of investments you need to know. Okay, let's break down the main ways you can actually invest your money. First up, stocks. A stock is a share of ownership in a company. When that company grows, your stock grows. When it struggles, your stock might drop. Stocks are one of the best performing assets over long periods, but they can be volatile in the short term. Think of them as the engine of long-term wealth building. Next are bonds. A bond is basically a loan you give to a company or government. In return, they promise to pay you back with interest over a set period of time. Bonds are less exciting than stocks. They don't grow as fast, but they're also less risky. They're the seatbelt in your investment portfolio. They don't make the car go faster, but they protect you when things get bumpy. As you get older and closer to needing your money, you typically want more bonds and fewer stocks. Then there are index funds and ETFs, and honestly, for most beginners, these are the golden ticket. An index fund is a collection of many stocks bundled together. Instead of buying one company's stock, you're buying tiny pieces of hundreds of companies at once. For example, an S&P 500 index fund gives you exposure to the 500 biggest companies in the US, Apple, Google, Amazon, and hundreds more, all in one purchase. It's built-in diversification. It's low cost, and historically, it outperforms most professional fund managers. Yes, you read that right. There's also real estate. Buying property to either rent out or sell later for profit. Real estate can be powerful, but it requires more capital up front and more active management. There are also real estate investment trusts, or REITs, which let you invest in real estate through the stock market without actually buying property. And finally, there are alternative investments like gold, commodities, and crypto. These can be part of a diversified portfolio, but they're higher risk and shouldn't be the foundation for a beginner. Stick to the basics first. Master the fundamentals, then explore. The magic of compound interest. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the idea holds up. Compound interest is the single most powerful force in personal finance, and most people only vaguely understand it. Let's fix that right now. Here's how it works. You invest $1,000. It earns 10% in a year, so now you have $1,100. The next year, you don't just earn 10% on your original $1,000. You earn 10% on $1,100. So now you have $1,210. The year after that, you earn on $1,210. Your returns start earning returns. It's money multiplying money. Slowly at first, almost unimpressively. But give it enough time, and it becomes a financial snowball rolling downhill, getting bigger and faster with every turn. Let's put real numbers on it. Imagine you invest $200 a month starting at age 22, earning an average of 10% annually, which is roughly the historical average return of the U.S. stock market. By age 62, you'd have over $1.2 million. You only personally contributed about $96,000 over those years. The rest, over $1 million, came from compound growth. Now, what if you waited until 32 to start? That same $200 a month at the same rate would only grow to about $450,000 by 62. You waited 10 years, and it cost you roughly $750,000. That's what procrastination costs. The brutal and beautiful truth about compounding is this. It rewards patience, and it punishes delay. The people who got rich through investing didn't necessarily earn more than everyone else. They just started earlier and stayed consistent. Warren Buffett, one of the greatest investors of all time, made 97% of his entire net worth after his 65th birthday. Not because he suddenly got smarter, but because compound interest had been building for decades. You don't need to be brilliant. You need to be early and consistent. How to actually start? Step by step. All right, enough theory. Let's talk about action. The first thing you need to do is open a brokerage account. A brokerage is basically a platform or app that lets you buy and sell investments. Think of it like a bank account, but for your investments. Popular options include Fidelity, Charles Schwab, and Vanguard in the U.S., all of which are free to open and have no minimum deposit. If you're outside the U.S., there are local and international options like Interactive Brokers that serve investors globally. Do your research for what's available and regulated in your country. Once your account is open, the next step is to decide on your investment strategy. And for a beginner, I'm going to make this simple. Start with low-cost index funds, specifically ones that track the S&P 500 or a total world stock market index. This strategy is so well proven that even Warren Buffett has said in his will that his family's money should be put in S&P 500 index funds after he's gone. If it's good enough for Buffett's family, it's a solid starting point for you. Now, how much should you invest? Start with whatever you can consistently commit to, even if that's $25 or $50 a month. The amount matters less than the habit at first. What you're building is not just a portfolio. You're building a behavior. You're training yourself to invest before you spend. Over time, as your income grows, you increase that amount. Think of your investment contribution like a bill that always gets paid first, before lifestyle expenses. Pay yourself first. Always. The last step, and this one is critical, is to automate everything. Set up automatic contributions to your investment account every month on payday. Don't make it a decision you have to make each month, because life will always find a reason to delay it. Automate it and forget it. The goal is to make investing so routine, so invisible, that you barely notice the money leaving. But years from now, you'll definitely notice how much it has grown. The mistakes beginners almost always make. Let's talk about the traps, because knowing what not to do is just as valuable as knowing what to do. The first mistake is trying to time the market, waiting for the perfect moment to invest. People say, I'll invest when the market drops, or I'll wait until things settle down. Here's the truth. Nobody knows when the perfect time is. Not you, not me, not the experts on TV. Time I in the market always beats time I in the market. The longer you wait for the perfect moment, the more growth you miss. The second mistake is panic selling. The market drops 20%, your portfolio is down, you feel sick, and you sell everything to stop the bleeding. I understand the emotion. It feels like damage control. But what you're actually doing is locking in your losses and guaranteeing you miss the recovery. The market goes down. It always has. But it has also always come back up. The investors who lose are mostly those who sold at the bottom out of fear. Stay the course. Stick to your strategy. Let time do the work. The third mistake is chasing hot tips and trends. Your coworker tells you about a stock that's about to blow up. A social media influencer is pushing some new crypto coin. A WhatsApp group is going crazy about some company. Listen, these things might occasionally work, but they're mostly noise. They're speculation, not investing. And for every person who made money chasing a hot tip, there are 10 who lost it quietly. Boring, consistent, diversified investing beats flashy bets almost every single time over the long run. The fourth mistake, and this one is underrated, is ignoring fees. A fund that charges 1% in annual fees might not sound like much, but over 30 years, that 1% can eat up 25% of your final wealth. Fees compound just like returns do, but in reverse. Always choose low-cost index funds over expensive, actively managed funds. Look for expense ratios below 0.2%. The difference over decades is staggering, and most people never even look at this number. Building a mindset that makes you wealthy. Everything I've told you today is useless without the right mindset. You can know every strategy, every fund, every trick, but if your thinking is off, none of it will work. Let's talk about how wealthy investors actually think. First and most importantly, they think long-term. They are not checking their portfolio every hour. They are not reacting to every piece of news. They planted seeds, and they are waiting for a harvest. You don't dig up a seed every day to check if it's growing. You trust the process, water it consistently, and let time do what time does. The second part of the mindset is separating emotion from money decisions. Our brains are wired to feel losses about twice as intensely as we feel equivalent gains. That's called loss aversion, and it makes us terrible investors when we act on emotion. When a market drops, our fear tells us to sell. When the market is skyrocketing, our greed tells us to buy more. Both are usually the wrong moves at the wrong time. The antidote is a clear plan, written down, committed to, that you follow regardless of how you feel in the moment. Third, wealthy investors are always learning. Not obsessively, not every waking hour, but consistently. They read one good financial book a year. They listen to podcasts here and there. They stay curious. The investment landscape does change over time, and the more you understand, the better your decisions become. You don't need to become a financial expert, but knowing just 10% more than the average person puts you in a genuinely different financial position over a lifetime. And finally, the most important mindset shift of all, start seeing yourself as an investor, not just a consumer. Our culture is built around spending. Buy this. Upgrade that. Treat yourself now. And look, enjoying your money is important. But every time you spend $100 on something you don't truly need, you're not just spending $100. You're also spending the $1,000 or more that $100 could have grown into over the next 20 years. That's not guilt. That's awareness. Once you truly see your money this way, every financial decision gets a little clearer, and your future starts to look a whole lot brighter.